Good morning. Good morning and welcome to the OTC Markets Group Thought Leadership Series. My name is Andy Kizik and I'm Head of Advisor Relations. We'll get started in just a moment as we are seeing participants log in. So we will kick off in just a moment. Just give it about a minute to get started. For those of you that are joining, just some general housekeeping. We will present on the topic of regulatory changes shaping U.S. equity research in the landscape. And then at the end, any questions, please put into the Q&A box and we will answer them after. Everyone will receive an email and a copy of this presentation, and this presentation will be archived on the OTC Markets website, as well as the OTC Markets YouTube channel. So I think that we are now populating with a nice group. So here we are, talking about the regulatory changes reshaping research and landscape for U.S. companies. Just switch to the next slide, please. We have a distinguished group of panelists here. We have research experts from the industry. First, Theo O'Neill, who is sell-side analyst since 1996 and worked at multiple investment banks during his career and was a Wall Street Journal All-Star Award analyst in 2000. He is the CEO of Litchfield Hills Research. He lives in Connecticut on a farm acquired by his family in late 1700s. So just a little personal note. And he's also quite a technical expert on Porsche 911. Jumping over to Peter Sidoti. Peter Sidoti is the founder and chairman and chief executive officer of Sidoti and Company. Focuses on research companies for small market caps. In 1997, Peter started off at Schroders, where he was responsible for research for healthcare group, for emerging growth group. He has since moved on to work as a financial analyst also at Value Line. Peter is also a registered broker-dealer at Sidoti and Company. And we also have Charlie Pippin, who's the chief executive officer of Water Tower Research, a global leader in financial industry. Charlie has more than 25 years experience across investment banking, sales, trading, equity research at leading firms such as Goldman Sachs, UBS, BNP Paribas. We're excited to have everybody here today, and let's just flip over to the next slide. I thought that because we have such a diverse group today, we would initiate our discussion to basically level the landscape. We have corporate issuers, some advisors, we also have some buy side. And I wanted to kick off with where we are today and a little bit of understanding of equity research before we move on to the changes that'll be impacting us in the next slide. So Theo, can you give us a little kickoff with some of the benefits and importance of equity research and how you see that today?
Yeah, so the purpose of equity research is to help investors understand the companies they're writing about, and also try to answer any issues about the company's past, what it's been doing, where it's going, that investors will feel comfortable enough to take the next steps that they have to take and do their own due diligence. And the idea is that the idea with research is that if you do the work that we've done, put together a model, write a research report, including investment thesis, that any institutional investors, in some cases retail investors, if they do the same type of level of work, they can come to the exact same conclusion. So when we put ratings on stocks, we put price targets on stocks, that other people can use that research and then extend it, do their own, and come to essentially the same conclusion. And it's part of a portfolio of ways that you're going to go and reach out to investors.
Peter, from the broker-dealer perspective, maybe give us a little insight into your model and how equity research and the importance of it from the broker-dealer perspective? And, how is research generally paid for?
Um, Equity research from our perspective is generally, it's almost a measurement tool that when a company reports earnings, a company talks about what its expectations are. One of the most important functions research is doing is providing a measurement tool, kind of like your temperature. It's good to know that your temperature should be 98.7. Unless you know it should be 98.7, it doesn't matter what your temperature is. In terms of how research traditionally has been paid for, research traditionally has been paid through trading commissions. Large institutions like a Fidelity or a T. Rowe Price will generally pay us 5 cents a share, or in the old days, 7 cents a share to trade a large block of stock. So an institution would pay us 7 cents to trade 100,000 shares of AT&T, and in essence, we'd receive $7,000. The system was structured that way because large mutual funds, large money managers are able to pass trading costs back to their investors. Those rules began to change very quickly in the last 4 or 5 years. As most of you know, you can walk down to your local Schwab office and trade for free, or Robinhood office and trade for free. So what has happened is the clients today no longer will pay with inflated commissions for research. And that's really how the change is. And that change started 6-7 years ago. And MiFID really has accelerated that process. In other words, research now is seen as a separate product that's not buried in the trading account.
Thanks, Peter. Charlie, from American Tower's perspective, I think of the firm more as a model where you provide advisory service / investor relations model. Maybe you can give us a little insight from your perspective on the landscape at the moment with equity research.
Sure. Thank you. And thank you everyone for joining and participating in this. This is a great topic. And I know if you're sitting there as a corporate, or if you're sitting there on the buy side, you see a lot of traffic on your news and what's happening with MiFID 2, no action letters and so forth. But I think what Theo and Peter were saying is really, you start with the importance of equity research, right? You can't be invested in if people can't do a due diligence on you, right? The importance of having that due diligence package is immense for portfolio managers, retail, institutional, and so forth. So the key to having equity research, I think, stands on its own. You need to have that as a small, mid, or even large cap company. It's easier for the large caps than the small and mid caps. What we do as an organization is really help educate the market on your company, why you're doing things, the strategy, inflection points, how things are changing, and really investment thesis around you as an organization. We feel like it's very important, right, for the small and micro cap companies out there are really the backbone of the US. And during this time of change within the larger ecosystem of capital markets, meaning the MiFID 2 changes and so forth, this will only drive more of a sort of complication for the smaller firms, because there is question marks on how far down will large banks go to cover companies? Will they have resources to do that and so forth? We'll get into that a little bit in the following slides on what the changes will actually happen and what will drive the market from there. But our business as a whole really thinks about it as an advisory standpoint. So we really work really closely with small and micro cap companies and even mid cap companies and help drive the message for them. We need, your need is to increase your shareholder base, right? Get more people involved and interested in your company. That's what we help companies do. We don't chase banking deals. We don't do anything from that perspective. So we take that piece of the element of this conversation out of it. And it's really about your messaging and driving good quality, credible research. So.
Andy, let me address that bottom bullet point on the slide, since that's where we're here. The equity research has never been paid for explicitly. It was started in the 70s by DLJ as a business line that would help drive trading volume. And it was never paid for directly. It was bundled as part of the cost of doing business with the firm. It was included in commissions. And so the SEC carved an exemption from the Registered Investment Advisor Act that allows broker-dealers to avoid registering as long as they're not getting paid directly for research. So what's happened in Europe is that changed in 2018. In Europe, they decided that it would be best to not have that cost of research hidden in commissions and break it out separately. And that would require getting paid directly for research, which is a conflict here in the United States. The SEC issued a letter saying that broker-dealers do not have to register as investment advisors as we look and evaluate how this MiFID II is going to impact the US. And that blanket letter to avoid registration expires this July. So that's what kicked off our conference, and that's where we're part of what we're talking about here today, although largely we're talking mostly about research in general.
A great segue into MiFID II, this acronym. So exactly there. So the European Union thought of bundling of research payments into commissions was hiding the actual cost for providing research. So in 2018, it became required that investors pay directly for research. The rule was part of a sweeping regulatory change known as Markets and Financial Directive, acronym being MiFID II. MiFID itself was established earlier in its actual implementation. And you know, we have this change coming up in July. And I think that the US, the European model has been in place preparing for this. How prepared is the US investment banking community to make the adaptations in the next several months to do this? And I want to put this to our panelists to see, what do you foresee as some of the potential preparations that are going to getting ready for this July no action letter change and implementation in the US? And then we'll move towards the impacts. Peter, do you have any insights on this from the broker-dealer perspective on what you need to do to prepare and how this is impacting your business?
Most firms on Wall Street, large firms, are already registered investment advisors who are broker-dealers. A handful of us are not. We, in fact, will have to do the paperwork and become a registered investment advisor, as will 3 or 4 other firms who do similar work as we do in where we go. So I think for the large firms, it's not going to be a radical difference. The interesting thing is large firms really have very little interest in small and micro-cap names. So whereas the smaller firms have much more reliance or are much more involved in that end of the marketplace. So the new rules, in my feeling, probably are going to require most of us just to incur some more cost and most of us to jump a couple more hurdles. As it relates to our clients, the institutions, it's going to require another line of paperwork for them. And for the last 5 years, with the beginning of MiFID II implementation, the institutions have used this as a way just to continue to squeeze what they pay for research. And my guess is just adding this next layer of difficulty will give institutions another reason not to pay for research or to try to minimize the cost that they're paying for research.
Charlie, you spend most of your times working with advisors. Okay, you are an advisor to corporate issuers. What impact are you anticipating, or how do you prepare yourself for the changes you may have to make in providing sponsored research for the corporates that you represent?
Well, that's a good question. So we are going down and going to register as a registered investor and advisor ourselves. We just think that's a prudent way to interact with the market. MiFID II, really, just to boil this down, is the unbundling of commissions and research, right? So why would you do that? Transparency. So Europe really wanted to drive transparency in the markets. The US said, oh, that's interesting, but we're not quite prepared for that due to some of the rules that Theo had mentioned, right? You have to be an RIA, a registered investment advisor, in order to take hard dollars on specific research. So they issued that no action letter saying, you guys go sort this out for a while. But in 2023 in July, they're going to let that go away, and therefore the industry should be ready for that. My impression is that transparency is always better than opaque fogginess in the markets, right? I think everyone would agree with that. So us as a business, we don't necessarily have to do anything. We are going to be an RIA, but that really has nothing to do with the no action letter expiring. It's just a prudent measure to have that extra layer of regulation and involvement within the markets. So we feel like that's important. But from a corporate side of things, if you're thinking about, okay, great, what do I do now? Does this affect me as a CEO or CFO or an IR person within an organization? I think really what I would be thinking about is, what kind of research do you have now? Are you looking to get research? If you're covered now, is that really shadow coverage? Is that just a small broker dealer saying they cover you because you've done some banking relationship with them? Or is it more involved where you can actually have conversations with the analyst and describe your methodology and your traction within your particular market segment and be able to communicate that to the market, right? That's key. If you're a small and micro cap business, it's difficult to get attention on yourself, get the spotlight shown on yourself. So research is hugely important for you. We have these conversations, as Andy, you mentioned, we're an advisor within the market. We get tons of small companies calling us regularly about what it is. What do I look for? How do I get this? Where do I go? Our recommendation is always look for folks that are credible within the market space. We use only Wall Street analysts on our firm. So we want to keep and drive that credibility that's going on. So we look like a broker dealer and a regular bank, but we're just not chasing banking deals. So that's a little bit of what I would think of.
Thanks. Theo, as a pure analyst, do you have any comments to what our colleagues have said and or how it impacts you and your business?
Doesn't impact our business. I'm not sure we're going to be registering as an investment advisor, although I've done that in the past, and it's not daunting for us. The issue for broker dealers is that they're already highly regulated business with a whole bunch of rules related to being a broker dealer, and how many of them are going to want to actually add in another layer of regulatory environment and bring in the people to manage that aspect of the business. And that leads me to believe that we'll see less coverage. And like Peter said, the bulge bracket firms already have a division that's registered as investment advisors, so we're not losing any sleep over that. But I think for some of the smaller broker dealers, and particularly the ones who have European clients, I think there'll be a loss of readership, loss of equity research.
Yeah.
So let's flip to the next slide. I want to start getting and really focusing and zeroing in on the impact of the rule changes. And as we were organizing in our pre-panel calls, we really were trying to narrow down two things. How will corporate issuers really be impacted in the US and non-US companies be impacted at the small cap level? And I want to start with you, Theo. What are some of the things that you really see that will really affect the US equities and non-US equities that are quoted here?
Oh, well, I think you should reach out to if you're getting coverage right now, you should reach out to your analyst and ask them what their firm is planning to do with regard to this rule change. And again, in that way, sort of be prepared in case there's steps that you need to take to either find other coverage or get prepared for any changes that might come as a result of this.
Charlie, you have a diversified group of clients. What are some of the short-term effects that you're starting to see around US and non-US companies that'll be impacted by this, and how should they be worried and thinking about this as well?
Yeah, that's interesting. So we cover companies on a wide spectrum. So about a third of our business is above $1 billion in market cap. A third is between 100 and $1 billion, and a third is less than that. So we really talk to quite a few folks across the ecosystem. About 75% of our companies already have equity coverage. So when we talk to them, the importance of our coverage just becomes more relevant. And same with Theo and same with Peter is, there's going to be a significant amount of dropped coverage over time. that just is an inevitability of making things more transparent. I think one of the worries from, if you're looking at this from the investment banking side, is, most of them have RIAs. We're absolutely right. Some of them don't, depending on where they put their business, in the RIA or in the broker dealer, they'll still have to figure that out. But ultimately, with commissions compression, I think that's what Peter was mentioning, is as commissions compress, now it's just much more relevant on, okay, I really want to trade with these folks over here because they have high frequency trading, or they can get me to the markets much faster at a cheaper price, but I like these other folks for research. This new directive allows participants to go in different directions. When you bundle things, you can't. So you're forcing someone into, hey, I like XYZ broker dealer for their research, I'll just give them the commissions, or hey, I like these other folks because for their trading, fine, I'll just pay them for the research as well. So overall, I think the transparency will be good for the market. For smaller firms like yourself, the impact is that companies, broker dealers, will have to justify their research departments now. So is there enough income to justify the amount of analysts within our departments? And can we justify covering this many companies? The answer probably is going to be no. I don't have if I had a good crystal ball, I'd probably be a lot wealthier, but for now, the assumption is that they won't be able to justify the large headcounts within these research departments, and therefore they will have to go down. Now, you can cover the same number of companies with less people, but I think Theo can argue, the same as Peter, is your coverage is going to be a lot less than what you were used to. It's going to be more shadow coverage, as we call it. And then the more extreme part of it is you're just going to get dropped if you're an issuer that is just not in the wheel space, right? So they'll drop sectors, or they'll drop analysts that cover certain areas, and then you'll get dropped along with them. So,
when I think about some of the impacts, I always think of the corporate issuer here. And although we're talking a lot about what investment banks need to do, and there's going to be a contraction of coverage, there's a lot of corporate issuers that don't currently have research. And one of the questions that comes up is, to me, what should corporate issuers start thinking about in preparing to get research? What is the right way? What is the right way to prepare myself for research? Peter, I know that you came back on. We lost you for a second. But the question I wanted to bring to you, Peter, is, does equity research, or I'm calling it sponsored research, does it really pose a conflict? And how do you dissect, and this will be for all of you, the quality of companies that you'll cover? Maybe you can talk to that from the broker-dealer side a little bit.
I think a couple of quick things here. First, as we were talking about earlier, it's our belief that equity research is heading in the same direction as debt research. In the world of debt doesn't trade well, and there aren't large commissions. So what happens is companies have to hire research or pay for research in the world of debt. They pay Moody's, they pay S&P, they pay Fitch. And the world of debt has always had the companies pay for the research. With the falling off of commissions and things changing, we think that equity research is heading in the same direction. The question often comes up about the potential conflicts of interest. And I always think there's a certain layer of arrogance when people ask me that question, because even the smallest retail investor knows that research today is an unprofitable product, and most of it's funded by investment banking. So this idea that you're getting research and it's independent and nobody knows for a small or micro cap company is really, kind of foolish. I think, everyone knows that research is funded now, as I said earlier, by banking. And as we often explain to people, who's more conflicted? A firm that's chasing after an investment banking fee of $1 million or $2 million, and not disclosing anything, or a firm like ourselves or Water Tower or Litchfield, who disclose what we're getting paid, and generally are getting paid not nearly those types of numbers. We charge $50,000. And I can assure you that given what we charge, we're not going to sacrifice our firm's reputation. We're not going to sacrifice our analyst reputation for that small amount of money. So, the conflict really hasn't been there. The one thing I would mention too is we work with many, many institutions. The institutions treat all our research, both our company-sponsored research and our traditional research, the exact same way. They're speaking to the same analysts. They see the exact same product. They generally have a pretty good feeling for where our product is. So, when it comes down to potential conflicts of interest, I really think that boat has sailed a while ago.
Yeah, I would totally agree with you, Peter, on that. I think, if you were talking to a issuer 5, 6, 7 years ago, issuer sponsored research had that kind of connotation around it. Excuse me, that edge of, oh, I don't know if I want to do that. And now with the proliferation of kind of sponsored research across Europe, across the US, firms like Sidoti, our firm in Litchfield, that just argument is kind of dissipated very quickly. And you're absolutely right. The credit market's been doing this for a very long time. That is just common practice there. We look at it as independence and objective, the same way Peter and Theo look at it, as it's a due diligence package on your organization. Now, we particularly don't do buy, sell, or hold to remove that conflict there. Other firms may or may not. That's okay. But if you think of it from that perspective, there's, all of us have been in the markets for a very long time. I worked at both sides, on the debt side and the equity side. There's conflicts riddled everywhere. So I think most folks are conscious of that. And so these conversations of conflict of interest, I can't believe should we do this or not? I honestly, in the last 6 months, have not had that conversation with any of the issuers. They're more interested in how do we produce it? Who's writing it? How frequently do they get it? What are the KPIs basically for the organization when they're thinking about getting sort of analyst-driven investor relations, as we call it, or company-sponsored research? So,
and I'll add that I think that the traditional way of research coming from broker-dealers is unsustainable. The economics are not there, and what's happened to try to get the economics better is that each of the investment banks has restricted access to their research to only their paying clients. So while you can go to a regular broker dealer and get research, the fact is that it's not going to be universally available. It's not going to be available to any prospective investor. The only way you can get something that is available and out there in the world for any prospective investor is to hire one of our firms. Yeah. And I would add too that we all use Wall Street analysts, and we were all trained with FINRA rules. So we all have our own reputations to protect. So there's no issue here, I think, generally with company-sponsored research in terms of objectivity.
Yeah, Andy, I will note one question we do get is a lot of our companies are already covered by broker dealers, and this is kind of a tangential funny story. Is they call us and say they can't get their own research. So Goldman, Morgan is covering them, yet they can't even get their own research, and it's about them. Why? Because they don't pay them enough commissions to get the research. So it's kind of if you want to look at it objectively from far out, do you want a market that's opaque and only certain people can get research, like what Theo is saying? Or do you want a market where everyone can get the research? You can acquire as many investors as you possibly can and really build your reputation from that perspective. I think everyone knows the right answer. But of course, the investment banks, they're critical to our market. Where no one's here to badmouth the investment banks at all, because we've all worked there and we know how important they are into the capital markets. But in this one instance, it is a difficult model for them to continue to do. Like Theo said, it's just the economics aren't there to pay for the amount of research coverage that they do provide. So it is changing, and it's how quickly you want to get involved in it. That's all.
These are really good points. I know that, first of all three of these participants in our webinar today, both Sidoti, Litchfield Hills, and Water Tower, are vetted service providers and members of the Premium Provider Directory So we go through quite a scrutinous review process to determine that the broker, that the research house, the research marketplace is approved. So typically, if you as a corporate issuer don't have research, there's no reason to wait. You should have that as a objective voice, reiterating what you're telling the market and having that published. We do allow all of our corporate issuers to publish their research on the research portal, subject to the distribution rights they negotiate with their research provider. I think we've made some really good points here, both from who will be impacted. Before we jump over to trends, we have seen a very large group of companies start to really increase their equity research across our premium markets of OTCQX and OTCQB in various forms. Are there any suggestions that you might have for a corporate issuer in determining, what they should do to select or things to look out for when they're looking to hire a research firm? I'd just like to get just a couple of quick comments from you. Feel free to jump in and answer if you like. I think it'd be helpful for our corporate audience today.
Sure. I mean, I'll start out. I think we'll all have our different angles on this particular question. It's an interesting one. We get asked, when do you start, or how do you assess? And it really just comes down to, the how involved you want the issuer to be involved with you. So Water Tower, we get quite involved with our with the companies that we cover. We're non-prescriptive, so we try to produce as much content as we can. There's a reason for that. The reason you get equity research, I think this really just comes back to the beginning, is you need to have that objective third party to write about you in order for portfolio managers to invest in your security or make investment decisions about the security. They're not going to stand out there and say, hey, I found this one company, there's no research on it, and I'm going to go invest in it. That's just, that's not going to happen. The portfolio manager is never going to put themselves in that situation. So for us, having these conversations with these smaller companies, they may not realize that you will not get invested in on a large capacity and in a meaningful way unless you have equity research. Someone needs to point to something and say, hey, these guys wrote this about you. You can go talk to the company yourself or read the content or research. And so that is hugely important for you. So if you're going out there to look for someone to help you do that, you obviously talk to Peter, Theo, or myself. We have different angles on how we approach it, but it's really down to the KPIs. What do you get out of it, right? What is it that your investment, your ROI, we always talk about that internally about making new investments in the organization. The same goes here. What's your ROI? How much coverage will you get? How frequent will it be? Who is covering you? All of these questions you want to ask the issuer like Peter, Theo, or myself.
Peter, any thoughts?
We're a little different in that we have spent almost 25 years building up a reputation of covering companies that generally are profitable, generate cash flow, or companies that we can understand, that we can value in terms of where we are. So, we don't do tech, we don't do biotech as far as research goes. And it's someplace we've never had an expertise on. We tend to really focus on blocking and tackling. We do not, also, we really work very hard at not trying to work with someone who needs to raise equity near term. For us, that adds a layer of risk that we think our investors generally don't have an interest in. And we, of course, we don't provide IR services in what we do. So as was said earlier, we all do the business a little bit differently in how we attack it and what we do. But I think what you really have to do is look at who brings, the most to what you need and who brings the most to the table.
So it's not just when you need to get and raise capital. In other words, you need to kind of have an ongoing process.
Yeah, well, that's just in terms of needing research, but in terms of who you use or how, I was thinking more in terms of who you would select. And if you were looking or talking to someone to providing research, I, in all honesty, can't understand, and to this day still don't understand, why all companies don't want research. What we have found has been interesting, and I don't want to speak for Ted or Charlie, but that, companies who usually come to us who provide research generally tend to be the better quality companies. Companies looking for research tend to be better quality. It's interesting. A company that's looking for research generally is a company that has a CEO who very much wants to get a story out, has a CEO who wants to tell a story, and also generally knows he has pretty good numbers coming up, because he doesn't want to be visible if he doesn't have good numbers. So it's funny, when we look at the companies we've worked with over the last 5-6 years, those stocks actually have done extremely well. Part of it is, we like to think, is our research, but a lot of it is the companies have really posted good results and shown, have really shown why they wanted research to begin with.
I think that's
Theo,
yeah.
Theo, you want to jump in for a second? Give us some of your thoughts.
Yeah. So I think you want to look at, in terms of selecting, in terms of evaluating the firms. I think you want to look at who's reading the research, what their distribution is, how far does it go out, examples of what they've done in the past. And I think we all pretty much adhere to FINRA rules. We make that clear in our research reports. I know Peter does, probably do Water Tower too. So there's a quality aspect. You mentioned getting vetted by OTC. So there are objective metrics you could look at for sure. And I think, going back to what Peter said, generally the timing on this is when you've got something relatively good to say. I don't think you want to have part of an investor outreach program in advance of a bad quarter. But when you've got some good things that you've lined up, I think that's a good time to get research. And in terms of the timing, I think all of us are generally we can do an initiation report in between 30 and 60 days. Varies depending upon the company and what the objective is.
So I'll throw a little element of conflict in here, Andy. You'll like this. We look at this a little differently from the perspective of, just to make this interesting, guys, that even if you're having an inflection point on a negative side of you need to be out there communicating your story. When you start communicating only when times are good, you're not going to find that investor who can understand what's happening and how you got to the good stage, right? So if you have a full suite of information going back a year or 2 years or even longer for a lot of our clients, is you create this education process where, hey, they said they would do this happened or it didn't. This did happen or didn't happen, and then you see that evolution. That's way more important, and you'll get a better result from your investor community if you're continually out there and discussing with the market your objectives, your strategy, your financials, and so forth. Even in a bad quarter or a good quarter, it's very important that you do it consistently.
These are really great points that we have. I want to jump to the next slide because I think it's really important to reiterate the trends that we're seeing, okay? To really quantify the fact that if you are a small cap issuer, you really need to start organizing yourself and engaging in research, because people will read about you and try to better understand you before they even consider speaking to you. So Theo, maybe you want to take us through a little bit on the revenue trends that we've seen. Thanks to the courtesy of the New York Stock Exchange. We've got some data here. Let me kick it off to you.
Yeah, so this just follows up on what Peter was saying and what we've all been saying, that the traditional model is not sustainable. This is a chart showing commission trading, commission volume in dollars on the New York Stock Exchange over the last couple decades. And you can see that it's been trending downward. since 2000. And that's that would suggest is going to continue to go down. It's not going back up again. And part of all of this stuff with MiFID II, with changes in regulatory environment, it's just and you can trade stocks for free now. The money and the commission isn't there to make this a sustainable business as it's been in the past. And this right next to it, the statistics I have here are looking at the companies by market cap and what their coverage is. And what you can see is that generally companies under $250 million are left behind in terms of coverage. And that's something that you can all take control of and fix with any one of our firms. But 15% of all companies under 250 million get coverage, but it jumps to 80 once you're between 250 million and $1 billion, and it hits 100% essentially if you're in the $10 billion and up range.
If you're looking at a majority, Peter, I'll jump to you in a second. If you look at the majority of the companies that we see in our model on OTCQB, you're really defining that 15%, and we have quite a large amount. Although OTCQX has got a significant portfolio of global super caps who have multiple coverages across different banks, the OTCQX, which is our highest market, our best market, has a fair amount of companies in the 250 million plus zone. But again, for companies that trade on OTC markets, a lot of them don't have the coverage. And I really want to reiterate the fact that it's a great tool to have that you can post and distribute to your investor. Peter, I want to jump back to you. You're about to say something. I don't want to cut you off, even though I did. So.
No, the only thing the point I wanted to make a little bit was, in 2000, 2001, there was a lot to do because investment banking had a great deal of control over research, and there was a lot of laws passed, a lot of regs passed. I would say today that because of these declining commissions, as you see, investment banking has more influence over research than ever before, despite what took place in 2000 and 2001. And I really think that, these numbers just make it clearly evident that there are more analysts on the street than ever before. There's more general research provided than ever before. Bigger companies like an Amazon may have 60 firms covering them. So, that the influence of investment banking has been much greater. And I do think that, we are getting to the point now with investment banking activity slowing down so dramatically that you are going to see coverage start falling very, very dramatically along all sectors and all market caps.
Charlie, any thoughts?
Yeah, no, what Peter said was spot on. I think with the investment banking businesses and the capital markets generally freezing up a bit within the last six months or even a year, that's just going to have a knock-on effect within research departments, because that's how it gets funded, right? So if you know that relationship and you know it well, it's an obvious sort of foregone conclusion that a lot of those divisions are going to be contracting quite significantly. If you contract, that means you're covering less companies. And guess what? The companies that are not as large or do not have as much banking deals will be first on the block. And that's just a natural course of reality. I mean, I think the good news, though, is that you have firms like Litchfield and Peter Sidoti and Water Tower Research that are there in a credible way to be able to cover you in a significant way, right? So like we said, we come in with analysts and sort of experience within the capital market space to make that adjustment for these small and micro cap companies that will just get left behind. So it's an important part of the market. And I think, firms like Litchfield, Sidoti, and Water Tower really help from that perspective.
These are really good. I want to save some time for going to questions. Can we just do a page flip, please, to the last page? I want to kick it off. We have a few questions I want to get to, and feel free to cross-talk and jump in on this. I'm a CEO of a small cap company that has research. What do I need to do in the short term to confirm whether or not I can continue to get research. Any guys want to jump in on that?
Sure, you just reach out to the analyst and ask them what their firm is planning to do in July.
I will tell you our experience is usually when a firm gets down to one or two firms providing research, it's a good time to start talking about getting new research. What you never want to do is be in a position where you have no research. And most firms, when they end research, and the way it's done is very abruptly, both for regulatory reasons as well as practical reasons. So, just having a few analysts doesn't make a change. The other point I'd like to make, and I think everyone would agree, so many firms who have research because of investment banking, particularly those who've come through the SPAC world, have research from large institutions, the large institutional firms, the large broker dealers. What's interesting is they really don't, those firms don't target the small cap investor. They don't target the micro cap investor. Part of what you have to do is understand that just because it's a large firm, oftentimes the smaller firms get left behind because that's not what these firms' expertise is at. So again, when you look at the existing research coverage you may have, you really want to work with someone who does work with small and micro cap companies and people who buy small and micro cap companies.
Yeah, that's a great point, Peter, where the distribution level and engagement for a large company that's covering you is, how many times can you call Millennium? How many times can you call, Fidelity and so forth? I think what Peter is really driving home here is very important for folks on this call is you have firms like ours that work, and Peter and Theo's firms that work in the space of small and micro cap companies. That means we are dealing with investors that have the ability to invest in those particular companies. You want to work with folks like that. It's great to have a logo on your, I worked in the prime brokerage business. Everyone wanted to have Goldman's logo on their offering memorandum because that's who the prime broker would be. It'd be really cool to have that. But ultimately, what you're not getting if you go for the large one is access to the full suite of investors across the broad spectrum, from retail to folks that invest in the SMIDs or small and micro cap companies, and even on up the chain. You want to make sure that you're open to all of those folks and not just the high end, which frankly, if you're a small company and trade fairly illiquid, you probably won't be introduced to them anyways, because Millennium or Fidelity or the other folks won't be able to trade in your stock anyway. So
these are good points, particularly which kind of I want to just reiterate, we had a question, what are things to look for? Distribution, understanding that the audience of your research has an appetite for small cap companies and micro cap companies, because you might be calling up the wrong research house if they're only doing very large investors who will only invest in billion-dollar plus companies, and you might be a 30 or 50 million market cap company. So these are really good points. I have another question here. And this is more of a generic one. We've addressed this a little bit, how we see the corporate landscape for research looking like and where it's going, and it's going towards what I call sponsored research, for lack of a better word. Companies are going to have to pay their way to get research, and I think the shift in that is changing. We talked a little bit about initiation and timeline, 30, 60 days, maybe a little longer with company participation. One thing I did want to ask you though, in preparing for research, what should a company have? Should they have an investor deck? How should they prepare to talk to a research house? Maybe you guys can give us a quick synopsis on what should a company do to be prepared to initiate with a research provider.
who wants that one? Peter?
I'm going to duck this one. I'll let you guys go.
I can help answer that one. So, when you prepare to get equity research, it's really, most likely if you're a public company, you already have an investor deck already. You want to make sure your investor deck is clear, concise, gets to the point, drives the message of what your firm is doing, why you're doing it, and where your profitability is. That's all very important. Most likely you already have that, but you want to make sure that that's cleaned up and looked at. You also want to be prepared to have regular dialogue with firms like ours, right? This isn't a go send us some paperwork and we go write you an initiation of coverage. At Water Tower, we have regular interactions with all management within the organization. So you want to be prepared to interact with firms like Sidoti, Water Tower, and Litchfield on a regular basis. It's very important for you as a firm to make sure that the analyst understands the direction, the strategy, and so forth, and obviously the financials as well, when they're building their model and understanding your business. So there is a bit of work that's involved when getting it, but it pays off huge. And at the end is that people will understand your business better if the analyst understands your business better. So, Theo?
Yeah, what I'd say is if you've got a good investor deck, it makes the time from beginning to launching an initiation shorter. If you don't have one, it'll add to the length of time. But having said that, it doesn't matter to us whether or not you do, because we'll be putting something together, and we can do it with or without a good investor deck, although it makes it a lot easier if there's a good, clean investor deck.
Gents, in the interest of time, we're running out of time. I'm getting the call from our platform to say we need to wrap it up. Can you give us any quick closing thoughts, each of you, before we close? A copy of this presentation will be available to everybody who's logged on. It'll also be posted on our website and our OTC Markets YouTube channel. But Peter, let me start with you. Any quick closing thoughts or sound bites you want to just share that maybe we haven't covered?
I guess the thing that I would say is, the world is changing very quickly. The whole brokerage business is going to look very different 5 years from now than it does today. Given the changes that are going on, rising rates, everything that's happening, from my standpoint, I really think you have to be in front of things and not behind them. And I think you have to, when you're looking at getting research, looking at getting visibility, looking at which way the market's going, I don't think that you have to look backward. You have to look at what's coming in the future. And I actually, as we've all said in the past, but I really think that company-sponsored research is the wave of the future.
Charlie?
Yeah, no, I 100% agree with that. You got to be proactive as you're running your organization. You have to be proactive in nature in all aspects of running your organization, internally and externally. This is the external part of what you need to do as running a small business or a micro or small cap company. And this, it's been going on forever in the credit markets. Peter has very astutely mentioned that, right? The credibility is there. You have firms like ourselves that have very smart people have been working on Wall Street for a long time, understand all the rules and regulations around it, and can put together very high quality research. And so, I think what Peter had mentioned, and I'm sure Theo would agree with, is there's no time like the present, and you should get ahead of this before it gets in front of you in a way that's puts you in sort of behind the eight ball when it comes to getting investors involved in your story and building your investor base. So, that's exactly right. I would just stay ahead of this if I were thinking of company-sponsored research, or we call it analyst-driven investor relations, but it's all the same thing.
Takeaways?
Yeah, I just say that, why equity research is that it makes your company discoverable for analysts that are screening for forward-looking earnings. It makes your company look interesting because people like to discover new ideas. They're generally leery of a company that has no coverage at all. It convinces investors to take the next step, and it should be part of a portfolio of outreach to investors.
Yeah.
Gentlemen, I really want to thank you again. A copy of this will be mailed to everybody who's registered, and also will be archived on our website probably by tomorrow. Any questions that we did not get to, we will get to you either ourselves or with our distinguished panelists. So thank you, gents. And thanks for logging into the Thought Leadership Series at OTC Markets. Have a great day.
Thank you.
Thank you, Andy. Bye-bye.